Now, a capital gain. Well, capital gains are a little bit complicated, and you do have to know the rules for capital gains a little bit. This is especially relevant in the life insurance industry because a capital gain arises when we have a disposition of property. A disposition is any situation that arises after which I no longer own the property. So a disposition, that is, I'm going to have to pay a capital gain if I sell something, if I give it away, if I donate it, if I die owning property that has appreciated. And any of a number of other circumstances, such as changing ownership, such as substantively changing the use of the property from personal use property to income-producing property, emigrating from Canada. These are all situations that can trigger a capital gain. So, and one other noteworthy point here is that life insurance is not subject to capital gains. Segregated funds are. You'll learn that when you get to Module 13, but life insurance is not subject to capital gains. Life insurance, like we said, is taxed, if it's taxed at all, as regular income. So here's what happens. I bought a piece of property for, let's say, $1,100. Okay? Let's say that represents the value of an investment in a company. And then later on, I was able to sell that piece of property, that investment in that company, for $1,200. Well, the $1,100 is what we call the adjusted cost base, or ACB, for that property. So what had happened here? Well, I really came out $100 ahead. I made $100. The original $1,100 that I bought the property with was my after-tax dollars. That was money that I had left over after I'd already paid Revenue Canada the taxes that I owe them. So Revenue Canada never wants to tax that again. They're happy to let me keep my $1,100, that adjusted cost base portion, tax-free, but they're going to tax that $100 difference between the $1,100 that I started with and the $1,200 that I now have. That $100 is what we refer to as a capital gain. Now, they say if you earn capital gains, we're not going to tax the whole portion. In fact, we're going to give you a little bit of a break here. They're only going to tax 50%. 50% is what we refer to as the inclusion rate. Capital gains date back to 1973 in this country. When they were first introduced, 50% was the inclusion rate. For a time, the inclusion rate rose to 75%. Then briefly it was down to 66 2/3%, and in 2000 it fell down to 50% again. So we have capital gains taxed at a rate of 50%. Not every disposition of property results in a capital gain either. A disposition of your principal residence does not generate a capital gain. That's not a taxable event at all. So now we have $50. The $50 is what we call the taxable capital gain. Watch for this language on the exams. That if you see reference to a capital gain, that's the amount before the 50% has been applied. If you see the reference to the word taxable capital gain, that's after that 50% has been applied. So really what happens here, we cut that capital gain in half. We allow you, Revenue Canada allows you, the taxpayer, to keep 50% of your gain completely tax-free. They're only going to tax half of it. So now we have a taxable capital gain of $50. We apply that marginal tax rate again of 22%, and you would have $11 in tax to pay. So you made $100, but you're going to lose 11 of it to taxes. And that means that out of your $100 profit, you walk away with really $89 net of taxation. This becomes especially important for life insurance purposes because if somebody dies owning property, that property is considered disposed of on their death. Now, it can be transferred to a spouse, and the spouse can then take that property on without having to worry about this tax right now. You, of course, have seen that, or will see that, in the Wall of Death presentation in this module. But if you die and you don't have a spouse to pass property on to, it's all going to be taxed. If you have a $300,000 cottage when you die that you bought for $100,000, that's a $200,000 capital gain. The money has to come from somewhere to pay those taxes. And really there are two ways to pay the taxes, maybe three ways. But you could write a check to Revenue Canada. You need to get that money from somewhere. That somewhere has to be maybe from other money you have or maybe from a life insurance policy. Or if you don't have the money, Revenue Canada will take the cottage, sell the cottage, pay the tax bill, and then divvy up the remaining amount between your heirs. So people who have property that they want to keep in their family, such as a cottage or shares in a business, will typically use life insurance to help support that aim. That's what we call estate preservation or estate planning. Okay, so as mentioned, there's not a lot to memorize here, but what you do have to know, the must know on the board here, is the capital gains inclusion rate of 50%. That is an absolute must know. That will be tested. You will see that on the exams. I wouldn't fight with memorizing the 45% and 19%. Like I say, for dividends received in 2010, those amounts will actually be reduced to 44% and 18% anyways. And you'll be given a marginal tax rate if you need it, so don't worry about memorizing the marginal tax rates. But I do think that it's useful to understand all of this for exam purposes, and also so that you're making sure you're doing the right things for your clients. You will have the opportunity to sell investments with your life insurance license that can generate income, dividends, and capital gains. Enjoy your continued studies. Thank you very much.